The Fed's research is a series of studies and reports that analyze the economic conditions and outlook of the United States and the implications for monetary policy. One of the main topics of the Fed's research is the level and trajectory of interest rates, which affect borrowing costs, inflation, growth, and financial stability. The Fed's research challenges the conventional wisdom of the new normal for interest rates, which is the idea that interest rates will remain low for a long time due to structural factors such as aging populations, low productivity growth, and global savings glut. The new normal view implies that the Fed has limited room to raise interest rates without hurting the economy or causing a recession. However, the Fed's research suggests that interest rates may not be as constrained by these factors as previously thought, and that there is more scope for monetary policy normalization in response to rising inflation and robust economic activity. The Fed's research also indicates that interest rates may need to rise faster and higher than expected to keep inflation under control and prevent overheating of the economy. For example, in June 2023, the Fed raised interest rates by 0.75 percentage points for the third time in a row, bringing the benchmark federal funds rate to a range between 1.5% and 1.75%. This was an unusually large and frequent rate hike that surprised many market participants and analysts who were expecting smaller and slower increases. The Fed justified its aggressive policy stance by citing its research findings that showed stronger growth prospects, higher inflation expectations, and lower estimates of the natural rate of interest, the rate that is consistent with full employment and stable inflation. The Fed's research also revised its interest rate projections for the future, showing that the median official expected interest rates to reach 4.25% to 4.5% by the end of 2023, up from 3.25% to 3.5% in June 2022. This implies that the Fed anticipates 4 more rate hikes in 2023, which would be a significant departure from the new normal scenario of low and gradual rate increases. The Fed's research thus challenges the new normal for interest rates by providing evidence and arguments that support a more hawkish and proactive monetary policy approach in the face of rising inflationary pressures and solid economic recovery. The Fed's research also implies that interest rates may not return to their pre-pandemic levels anytime soon, but rather settle at a higher level that reflects the changing dynamics of the economy and the financial system. The Fed's research challenges the conventional wisdom that interest rates will remain low and stable in the post-pandemic era. The Fed argues that the factors that have depressed the neutral rate of interest, such as aging population, low productivity growth, and global savings glut, are not permanent and may reverse in the future. Moreover, the Fed warns that the unprecedented fiscal stimulus and the rapid vaccination progress may boost aggregate demand and inflation more than expected, requiring a faster and steeper normalization of monetary policy. What are the implications of the Fed's research for monetary policy, inflation, and economic growth? First, it suggests that the Fed may have to raise interest rates sooner and higher than currently anticipated by the markets. According to the Fed's projections, the median federal funds rate will reach 2.5% by 2024, while the market expects it to be around 1.5%. This implies a significant upward adjustment in the yield curve and a potential tightening of financial conditions. Second, it implies that the Fed may have to unwind its quantitative easing (QE) program more quickly and aggressively than planned. The Fed has been buying $120 billion worth of Treasury and mortgage-backed securities per month since March 2020, expanding its balance sheet to over $8 trillion. The Fed has signaled that it will start tapering its asset purchases later this year, but it has not specified the pace and the end date of the tapering process. The Fed's research suggests that QE may not be as effective or necessary as before, when interest rates were close to their effective lower bound, ELB, and that it may pose risks to financial stability and inflation expectations if maintained for too long. Third, it indicates that the Fed may face a trade-off between stabilizing inflation and supporting economic growth. The Fed has adopted a new monetary policy framework that aims to achieve an average inflation rate of 2% over time, allowing for temporary overshoots after periods of undershoots. The Fed has also emphasized that it will not tighten monetary policy until it sees substantial further progress in labor market conditions, especially for low-income and minority workers who have been hit hardest by the pandemic. However, if inflation turns out to be more persistent and widespread than transitory and sectoral, as the Fed expects, the Fed may have to raise interest rates faster than warranted by the state of the labor market, risking a slowdown in economic activity and employment. In conclusion, the Fed's research challenges the new normal for interest rates and calls for a more proactive and flexible approach to monetary policy. The Fed faces a delicate balancing act between keeping inflation under control and fostering a broad-based and inclusive economic recovery. The Fed's communication and credibility will be crucial in managing market expectations and avoiding excessive volatility in financial markets. The Fed's research on the new normal for interest rates suggests that the factors that determine the equilibrium or natural rate of interest, R-star, have changed over time and that R-star is currently much lower than in the past. This implies that the Fed will need to keep interest rates lower than before to achieve its dual mandate of maximum employment and price stability. According to the Fed's research, some of the main factors that influence R-star are the trend growth rate of the economy, the demand for safe and liquid assets, and the degree of risk aversion among investors. The Fed's research indicates that all of these factors have contributed to a decline in R-star over the past 2 decades. For example, the trend growth rate of the U.S. economy has slowed down due to lower productivity growth and demographic changes. This reduces the demand for investment and lowers the return on capital, which in turn lowers R-star. The demand for safe and liquid assets, such as U.S. Treasury securities, has increased due to global financial instability, regulatory changes, and a preference for precautionary saving. This increases the price and lowers the yield of these assets, which also lowers R-star. The degree of risk aversion among investors has risen due to the experience of the Great Recession and the uncertainty about the future. This increases the premium that investors require to hold risky assets, such as stocks and corporate bonds, and lowers their expected returns, which again lowers R-star. The Fed's research estimates that R-star today is around 0.5%, compared to around 2.5% in the late 1990s and early 2000s. Assuming inflation is running at the Fed's target of 2%, this means that the normal short-term interest rate would be 2.5%, which is 2 percentage points lower than what it was 20 years ago. The Fed's research challenges some of the alternative views and perspectives on the new normal for interest rates. One view is that interest rates are artificially low because of the Fed's expansionary monetary policy, and that they will rise once the Fed normalizes its policy stance. Another view is that interest rates are too low because of a global savings glut, and that they will rise once global imbalances are corrected. A third view is that interest rates are too low because of secular stagnation and that they will remain low indefinitely unless fiscal policy stimulates aggregate demand. The Fed's research argues that these views are either incomplete or inaccurate. The Fed's research shows that interest rates are low mainly because of structural changes in the economy that have lowered R-star, not because of temporary or cyclical factors that can be easily reversed by monetary or fiscal policy. The Fed's research also shows that interest rates are not too low, but rather appropriate for achieving the Fed's dual mandate. The Fed's research suggests that raising interest rates too quickly or too high could undermine economic growth and inflation stability. The Fed's research has important implications for monetary policy and financial markets. It implies that the Fed will need to be more cautious and gradual in raising interest rates than in previous tightening cycles. It also implies that the Fed will need to communicate clearly and effectively its policy strategy and expectations to avoid surprising or confusing market participants. The Fed's research also implies that financial markets will need to adjust their expectations and pricing of interest rate risk to reflect the new normal for interest rates.